Well, welcome, Professor D. Narayana, and welcome the entire guest audience to today's talk on goods and services tax regime change in the era of globalization. That will be given by Professor D. Narayana. A nationwide GST was first proposed by the NDA government in the year 2000. An empowered committee was formed with Dr. Ashim Dasgupta, the then Finance Minister of West Bengal, as the chairman. And after that, 17 years passed, and finally, in the year 2017, it was rolled out. The discussion on GST has got special significance in the in the present time, especially after the recent GST2 reform, and especially in the time when the saving rate is extremely low, investment has slowed down. The ironically, earlier GST was blamed for making investment slow because a lot of this thing, and business communities faced a lot of problems after the implementation initially. So, what is the driver of the growth on the international trade front? Trade deals are getting disrupted due to tariff wars and hard negotiations with various countries. So the focus is again on domestic market. Boosting consumption, boosting production, investment, and raising GDP through this way. Some recent studies, interesting studies, found mixed results as far as some consumption baskets are concerned. GST has been found to be regressive. I mean, the people who are belonging to the lower strata, they are bearing the high burden of the tax compared to the upper income group, while some other study found it is progressive. Finally, in 2023-24, one research has been published in EPW, which showed that, well, 31% of the total tax collection is contributed by the personal income tax, and 27% by the corporate income tax, and 23% by GST. Well, with this short note, I think we welcome and invite Professor D. Narayana for his lecture, and I think it will be a very enriching lecture. Before finally he delivers his lecture, I introduce Professor Narayana. Professor Narayana doesn't need any introduction, but it is a formality. I have to do that. Professor D. Narayana is an eminent economist. He has profound expertise in public policy in general and public finance, health economics, labor migration, and development policy in particular. He is currently the advisor and professor of eminence at the School of Social Sciences, Ramaiah University. Earlier, Professor Narayana served as the director of the Gulati Institute of Finance and Taxation, GIFT, Thiruvananthapuram, and also as the RBI chair professor at the CDS Thiruvananthapuram. Professor Narayana has played an influential role in public policy in Kerala. He served as technical advisor to the Kerala State Planning Board from 2013 to 2016 and has been a member of the Kerala Public Expenditure Review Committee. He is also the chairman of the committee for the implementation of the Karunya Arogya Health Insurance Scheme aligned with Ayushman Bharat program. Professor Narayana was a Fulbright Fellow at the Harvard Center for Population and Development Studies and a visiting professor at the Unit of International Health, University of Montreal. He has served as the consultant to the ILO and Asian Development Bank. He led a landmark study titled Domestic Migrant Labor in Kerala. One of his major contributions in health economics is the edited volume titled Safeguarding the Health Sector in Times of Macroeconomic Instability, Policy Lessons for Low and Middle Income Countries. Professor Narayana holds a PhD from the Indian Statistical Institute, Kolkata, one of the premier academic institutions in India. With this short introduction, I now invite Professor Narayana. Please, sir, you just give your lecture.
Thank you very much for that not so brief introduction, and thank you for all those good words. It's a great opportunity to talk about GST because, as already introduced, GST is looked at very differently by different sort of people. But it's important to understand how it affects trade and how it affects consumers. It's a consumption tax. So, and then if it affects the consumers, then there's some way it has to be addressed. You see, if it's a unitary state, these questions take a very different color. But in a federal system, who has to take care of if it is regressive? If consumers are affected, who has to take care of this regressivity? Regressivity can only be addressed through expenditure on the expenditure side. Then who has to take care of it? That's an important issue. But I'm not going to get into that. I'm actually going to cover the basics of GST. What does it do? Why GST? And these are the sort of issues that I'm going to cover. What's happening to my presentation?
Vachaspati, will take care of this. Umesh and Vachaspati.
Anyway, let me continue with your permission, sir, because
yes, please.
Yeah, let it come whenever it comes. See, when we talk about taxation, GST is a tax. When we talk about taxation, I think starting point has to be Benjamin, what Jefferson in the US mentioned about it. He said, in this world, nothing can be said to be certain except death and taxes. This was, beginning of 19th century, or rather late 18th century, in the American context. Benjamin Franklin was mentioning this. And, that is the point. You cannot escape two things. If you are in any country, you have to pay tax. And it takes various forms. Now, around the same time, when Benjamin Franklin was mentioning this, you see, Indian state of Kerala, now, of course, it's a very progressive sort of a state, but those days, the cruelty of taxation is best expressed by an incident which is, reported in various forms. That is the Travancore kings. Travancore is the southern side of today's Kerala. There were two types of tax. One was called breast tax. Women, once they cross their 14 years, they have to pay what's called a breast tax. That's a lower caste women have to pay tax. They are actually not supposed to cover their breast and things of that sort. That was a social custom. And men had to pay head tax. These are both, more like capital taxes. You are living in a country, so you have to pay tax. And very cruel, because there were no exceptions. Lower caste men and women had to pay, especially women. So there was this, case of a woman called Nangeli, who lived in a place called Chertala, that is south of today's Ernakulam. She cut her breast and protested against this tax because it was such a cruel sort of a tax. And nearer to our own independence, you are all aware of the Dandi March of Mahatma Gandhi, because at that point, that is, in the 1930s, or even before that, ever since British ruled us, salt production and distribution was a lucrative monopoly of the British. Why it is lucrative? This has something to do with the elasticity of demand, because commodities or goods like salt, the demand is inelastic. So you are, maybe the quantity is small, but you cannot cut down the quantity that you are consuming. So you are, and it's almost like head tax. So if they had to have a monopoly, the British, they prohibited Indian populace from producing or selling salt. And Gandhi was, protesting against that. And the Dandi March was from Sabarmati to the, the Dandi near Surat. I don't know whether I'm pronouncing it right, but this is a famous sort of salt protest, and that is what rejuvenated our independence struggle. So I'm just giving this just to give an idea, because saying that what Benjamin Franklin said, how true it is, because you cannot escape from tax. Rulers often tax you, and that is the price that you pay for governance. Okay, this is the background. Now let us come down straight to who has to move the slide?
Umesh is there. So you tell which slide, sir, he will move it.
No, you have to go to the next, because I have covered already that.
Next.
Yeah, you see, this is what I was referring to, the breast tax. Next, please. That's about the salt tax. Next slide. Next, please.
But you please move the slides.
Yeah, you can. This is about the, Dandi March and the salt tax I was referring to. Next, please. Yeah. Now, yeah. Next, yes. Yes, stop here. Now you see what existed before GST was implemented in India was, of course, value-added tax, but I'm not going to cover value-added tax in any great detail. But before that, what we had was the retail sales tax. Now, you see, during that regime, I'm not going to show you the RST, but I'll, if you look at a receipt, this is the telephone, sort of my telephone bill of, before GST was implemented, it will look like this. That is, you have the charges, the monthly charges and all that sort of a thing, so-called telephone bill. On that, of course, it was not a goods tax, it was a service tax. There is a service tax of 12%. Then there's an education cess. I hope you are all able to see this. And then a higher education cess. Now you see, if you look at this sort of a bill, of course, you can make out that there is a tax imposed. Now, which level of government gets tax? It's not very clear from that. And what is done with that education cess or higher education cess? That's also not very clear from any of these things. Who charges it? And all that thing, because we have actually 3 levels of government, but none of that is clear from this. Next, please. Yeah. Now look at a bill, exactly same telephone bill. You look at that in the post-GST period. I hope you are able to read that. Now you see it has become smaller. Just look at that box where the bills, amounts are shown, exactly same structure. That is fixed monthly charge, one-time charge, a discount or whatever it is, and then the total charges. Then comes, look at it carefully, you will find CGST at 9%, SGST 9%. That's all the tax that you have. And the very terminology, CGST, SGST, it will be evident from the name itself. CGST goes to the central government, SGST goes to the state government. So, what is the total tax? State government, it's all clear from the bill. That is what GST structure has brought to the taxation regime. Very transparent, and you know which level of government gets how much and how it is done. You see, this clarity didn't exist before the GST regime came. You just couldn't make out what was happening, who was collecting the tax, which level of government. It was not at all clear. Of course, we in the trade, we would know when a service tax, okay, it goes to the central government or whatever it is. But the common man had no way of knowing that. That situation has completely changed. It's not just the common man, even the producers, everybody knows how much is the tax, how much is collected by the center, how much is collected by the state. So that's why good old days we used to say, good, simple tax. So there is a simplification. There is a transparency that goes with the GST. Next, please. Yeah. So as I said, under GST, consumer knows exactly how much the manufacturer charges. The price, like the telephone bill, you saw the charges. Then how much the government collects, that is which level of government, CGST, SGST, and what applies to the consumer also applies to the producer. Suppose a producer purchases a good, he will get a similar sort of a bill, charges, tax, and which level of government. Now, all input supply from registered suppliers will show the price and tax very clearly separated. Now, why this tax separately and which level of government? That's because GST, the producer, if you are a registered producer, on any tax that you have paid on inputs, you get it, returned, refunded. That's called input tax credit. Now, if you have to get an input tax credit, you need to have that in the bill. This is the tax amount for this government or this level of government. That is the importance of that bill, and that is the importance of this particular dimension, the input tax credit. Next slide, please. Yeah. So if it's a running business, what you would find is that the producer purchases inputs, pays input tax, and the producer sells output, collects tax from consumer, but the entire tax collected from the consumer is not remitted to the government. What he or she does is to deduct whatever he has already paid, the input tax, and then remits the balance. Now, this is possible because the producer is able to see before his eyes. His bill shows it very clearly what is the input tax and which level of government. How much should go to the CGST account and how much to the SGST account. This was not possible earlier under retail sales tax. So that's how GST is very transparent and it aids production in a big way. Next, please. Yeah. And how does GST work? Now, under GST, ideally, all supplies are taxed, but allows registered dealers to deduct the tax charged on their inputs. All the inputs which attract tax, that amount is, they can deduct from, whatever tax they collect from the consumer. What does that imply? That implies that tax falls on all the value added. and sum of value added at each stage of production is equal to total value added. So value of final sale. So tax is imposed on only the final sale. All the other taxes paid by the producer, he gets, it's refunded. But these taxes are collected in small chunks. That is, as I gave the example, sort of when a producer purchases inputs, he is already paying tax. Now, see, if he collects, he has to have 5 different inputs. So all these inputs produced by other producers, production means value added, tax is already paid. So that then gets added up. But at each stage, there is also this deduction, ITC. That is the sort of a system. Next, please. Yeah. Now, so what this does, the input tax credit, since that is reclaimed or refunded, now that is self-imposing because it's a setting off. You see, if you have a bill showing this much tax you have paid for input, now you need to collect that bill. Unbilled, you do not get refunds. So the effective GST that has a self-imposing nature. That's a very important point. And then what happens is tax doesn't fall on production or raw materials. Tax only falls on the consumers because at each stage of production, the producer can reclaim. Only the consumer is the last point of consumption and it doesn't go for any other production. The tax falls on the consumer, the final consumption, leaving production untaxed. This is one of the problems with the retail sales tax. When the production, the inputs get taxed, they become a cost. Your production decisions, they get distorted. Now, all such distortions are done away with under GST because true cost gets reflected in your cost structure, not tax. Nothing like a cascading of taxes happens under GST. It just cannot happen because you have the ITC. Next, please. Yeah, I have worked out an example to show what is really happening. Otherwise, all this cascading and all, I can go on talking, but it may not get registered. Take the first RST, that is retail sales tax. Just, take production as a two-stage process. If somebody produces raw material and there is a manufacturer who purchases that raw material and he does some more value added manufacturing and then he sells it to a consumer. Now assume that this manufacturer purchases raw material, the raw material price is 100 and there is a tax which is R% on that. So when he pays, the manufacturer pays 100, that is the value added by the raw material producer, that is the price that the raw material producer is charging, plus the tax on that raw material, that is 100 into that R%. So that is what the manufacturer pays to the raw material producer. Now, so the cost to the manufacturer becomes that 100 plus 100R. On that raw material, manufacturer adds a value of 400. So he sells what the manufactured good at 400, that is his value added, plus raw material cost, that is 100 plus 100R. That is the cost he has incurred, cost including whatever his margin, all that. And when he sells it, again, the same, tax that on his sale price, His sale price is 400 plus 100 plus 100R. 400 is the value added by him. 100 is the price of the raw material. And the tax on the raw material is 100 into R. On that, there is a tax when he sells it to the consumer. So that is why it is shown as 400 plus 100 plus 100R plus that amount into the tax. This is what happens in the retail sales tax regime. Okay. Now comes to GST. I hope it's clear. If something is not clear, you can even stop me now, because or else at the end we'll have to come back to this slide if this is not very clear. I simplified it to the extent possible. One cannot simplify it further, but I hope it's clear. In the retail sales tax regime, this is what happens. GST, same value added by a raw material producer is 100, and the manufacturer pays 100 plus 100R, but he needs to count only 100 as the cost, because that 100R, that is the tax he has paid the raw material producer while purchasing the raw material. He knows that he will get it refunded. So he needs to count only that 100 as the cost of raw material. His value added is 400. So the cost is 400 plus 100 as far as he is concerned. And the tax on it will be 400 plus 100 into R. I hope it's clear. Now you compare the two. What you get, you see that 100 into R in the first case, retail sales tax. Now that shows, if that enters as a cost, that means tax 100 into R is the tax amount. 100 is the price at which raw material producer is supplied to the manufacturer. But that 100 into R is the tax which enters as a cost element. Compare the two, because in the GST, under GST, it doesn't enter as a cost element, because the manufacturer gets it refunded. So it's not a cost for him. Under retail sales tax, there is nothing like refunding. So that 100R will enter as a cost. That's the first thing. Second, compare the next line. What you will find under RST, you have 400 plus 100 plus 100R into R. That is the tax the manufacturer collects from the consumer. Now you look at that and compare it with the GST line. You will see 400 plus 100, that is common to both. But then there is another element, 100R into R. Look at it carefully. There R comes twice. It's R square. That is, there is a tax on tax. 100R is the tax collected by the raw material supplier. Manufacturer has paid that to the raw material supplier. That's the tax element. Now look at the RST, 100R into R. That is a tax on tax. You don't find that in the GST, because a manufacturer, he knows that 100R he can straight away deduct from the tax that he has collected from the consumer. So it doesn't enter as a cost. Since it doesn't enter as a cost, there is no cascading of tax on tax. I hope it is clear. This, in very simple terms, the difference between retail sales tax and GST and what it does to production is a very, very important point. This is what people keep on talking about, that is tax entering as a cost and the cascading effect. Any discussion of GST in the production context, you will hear these terms. I hope I have been able to find that with this simple example. Next, please. Yeah. So, in the retail sales tax regime, if a producer has to get out of that, what he has to do is to come out of that system where he has to produce, purchase raw materials. One way in the retail sales tax system, producers did it is by going for vertical integration. See, if you are a producer, you go for vertical integration. What it means is that your raw materials also you produce. or if it's parts and components, you produce that. Then there is no purchase sale coming in, so the tax doesn't come in. That's one way of getting out of that tax entering as a cost under the RST. But not every producer can go for vertical integration. And even those who can go for vertical integration, they will lose out on economies of scale. See, there are a lot of advantages. The economies of scale, large scale production, your cost comes down. But if you go for vertical integration, you do not have that choice. So production can be inefficient. That's the price that you pay while going for saving on tax as a cost. So, of course, in a largely domestic sort of economy where you don't have to compete with the external producers, you can still do that. And because others who are going to compete with you, since they will anyway for them.
Okay.
Is there any problem?
Okay.
Hello?
Let us wait.
Hello?
Someone is talking on the phone. Please switch off the phone.
Sorry. Yeah. So, you see, if your market is largely domestic, you can still live with that because your competitor, you see, if you are a vertically integrated producer, what you lose on the economies of scale, you gain by those two things. That is tax and cost and cascading sort of a thing. So it will be inefficient. But if you have to compete with, compete in the export market, and if your competitor is from a country where GST is already implemented, you don't have the advantage. You will not have the cost advantage. So that is the main problem. Next, please. Yeah. Now, this is where the globalization issue comes. That is, if you have to be competitive, especially in a globalized sort of a situation, if you are not competitive, you will not have the market. You will be just put it out. And that's why this ease of doing business and all that discussion just came up. And when we talk about that, there are three types of constraints on competitiveness. That is infrastructural, administrative, tax regime. I'm not going to get into those first two. And in the third, the tax regime, that's where if you have systems like RST, the producers who wish to export will be at a terrible disadvantage. So tax reform or indirect tax regime change then becomes one of the reforms needed to improve competitiveness. That's the context in which GST becomes important in a globalizing world. Next, please. Yeah. Now, that is what, for example, Kelker, I think 11th Finance Commission or the chairman, you see, there is a very beautiful statement. I have quoted it in full. That is, a well-designed destination-based GST on all goods and services is the most elegant method of eliminating distortions and taxing consumption, that is not taxing production. Under this structure, all different stages of production and distribution can be interpreted as mere tax pass-through. That's what I was referring to, the input tax credit and refund. And the tax essentially sticks on silent consumption within the taxing jurisdiction. This is very, very succinct way of summing up what GST does. Next, please. Now, GST was first introduced in France in 1954, and it proved exceptionally successful. And that's why by about 2000, 150 countries had adopted, of course, GST, except the USA. Now, BIRD, one of the Canadian economist, famous on tax matters. He has a lot of research on tax. He calls it unquestionably the most successful fiscal innovation of the last half century. Perhaps the most economically efficient way in which countries can raise significant tax revenues. He brings another dimension to the issue. I'll talk more about it later. That is most useful, successful fiscal innovation. That's what we were referring to. All these RST problems, the problems of cascading, tax entering as a cost. You are done away with that. You are becoming competitive. Plus, as far as the government is concerned, it's a very efficient way of raising tax revenue. Now, here, of course, I have used value-added tax, interchangeably with GST, because at the end of the day, GST is also a value-added tax, as it's already evident from the discussion so far. Next, please. Now, GST, what is so important about it? It's a single tax on all supply, manufacture, trade, service provision. Earlier, you see, if you look at the Indian context, and if you look at my telephone bill that I showed you, pre-GST, what did you have? You had service tax levied by the central government. Manufacture, you had an excise duty, which would have shown up in any bill. Trade, you will have the retail sales tax. So, as opposed to that, in the GST, you have a single tax on all supply, that is manufacture, trade, or service provision. And tax rates are few. Ideally, one rate, at best two or three. Now, why is this important? You see, if you have to get a refund, now there can be problems if there are multiple rates. Imagine the rate you charge for the consumer is 5%. But when you purchase a raw material, suppose it's 10%. Now you see you're going to have a serious problem. The government will not have enough money to repay or refund that first level tax. And also it will complicate matters so much that bookkeeping itself from both the producer side as well as the government side will become extremely difficult. So the rates by definition under GST have to be few. Contrast this, some of you may not remember this, but those of you who are, like older like me, we will, the good old days, everybody will wait for the budget and to look at the tax schedules. The tax schedules would run into pages, turning, item mentioned and tax rate and all that. A number of 15, 20, 25 tax rates used to be there. That's compared to, with that, you cannot just do a GST. So GST, if you have to have an efficient input tax credit system, you can only have very few rates, uniform sort of rates. And that's why ideally it said that, one rate, at best two. Now, if you look around, moved over in September, recently September, this should have been done, when we started off, but I think wisdom and dawn, after about 7 years or whatever the reason. Okay. Now, if you look at the countries which have adopted GST, Australia, Denmark, Germany, Mexico, South Africa, they all have just 2 rates. Belgium, Argentina, and France have 4 rates. Now, few rates also means a lot for administration. You are leaving very little for discretion of the tax officials. And you know the implication of that. If you leave it to the discretion of the tax official, you know what happens. I don't have to elaborate. Next, please. Yeah. And of course, if your GST has to be efficiently implemented, all sales have to be taxed. But allow registered dealers to deduct the tax charged on their inputs, that is tax refund. Now that's how it is a tax on value added. And sum of value added, as I already described, at each stage is the total value added. That's the value of final sales. So tax is imposed on the value of the final product, but collected in small chunks from each link. And that's what Kelker so succinctly put. It sticks only at the consumption level, but it's passed through at the other stage. Next, please. Yeah. I already described this. So GST is charged on sales to registered dealers who use it in production, and they can reclaim. Self-enforcing, because set off or reclaiming input tax can be done only when he has a bill. So you cannot have unregistered sort of a sale purchase, then the producers don't get the benefit of input tax credit. So once you have that, the GST falls only on retail sales, where the consumer cannot reclaim. So GST is a tax on final consumption and leaves production untaxed, and the production decisions, they are not distorted. The production distortion, it is said, just goes away with a proper implementation of GST. Next, please. And as I already mentioned, it is self-enforcing. Suppose A, B, C are suppliers in the chain. If A does not remit tax, then B cannot claim it. So it is in the interest of B to ask for a bill when he purchases from A. Same for C as well. Now, C is selling to a consumer. Even if the consumer tells C that he does not want a bill, he may not oblige, because if he has already paid the tax to his suppliers, and if he had to reclaim it, he has to have a bill that he has sold it to the consumer. So, you see, that is why it's called self-enforcing. You are, in effect, you do not need to have a tax administration, official snooping on what you are doing and things of that sort, and visiting your establishment. That simply doesn't have to be there. Next, please. Now, of course, an ideal GST, its beauty is enhanced when it's broad-based. That means all goods and services are taxed. And ideal when there are few exemptions. Now, if you give exemptions to some commodities or some goods, then what happens is, if it is a producer good, if it's an input for a production, then you see it breaks the chain. So then this ITC will not work. And the rate has to be uniform, and the threshold not too low. Threshold is means below the threshold you are exempting. Exempting means breaking the chain. So ideal GST system should be one: few rates, few exemptions, low threshold. Now, uniform rate, fewer rates, what it does is eases return filing, tax set off, and so on. All those things which I was describing. You see, it simplifies all that. If it simplifies all that for the producer, the compliance cost does not go up too much. And acceptance improves with simple systems. So, and it's a great blessing for exporters as well. Dr. Subrata, how much time do I have? Next, please.
15 minutes.
Oh, okay. That's a lot of time. Okay. Now, this is exactly why GST has become popular, and over 150 countries have adopted it. Now, GST and selective excise taxes. When I say selective excise taxes, liquor and tobacco and a whole lot of those things, you have actually excise duty. GST is coming doesn't mean that they are not taxed. So the tax system becomes, on one side you have GST, and then of course a few selective excise taxes. These are all consumption taxes. Now, since these are consumption taxes, now let us turn to the consumer side. You know what happens is, as income goes up, your consumption as a proportion of income comes down. Savings go up. If income as consumption as a proportion of income comes down, the tax on consumption by its very nature will have a regressive dimension. Now, how regressive are these? What is the implication for income distribution? These are all things. That's what, while introducing it, Dr. Subhrata was mentioning. Now, we do not know much about it, but theoretical dimension, I will just discuss a bit. Next, please. Now, take this simple example. First part. Now, what I have done is, income tax, the first side, you see, what we have, the current system or any system for that matter, which has the structure, you have different slabs and you have tax rates which are different. Low at the bottom goes up. And then, suppose your, income level, if these are there, that's the third column. So what will be the tax amount? That's what I have shown on the fourth column. Now, incomes, 2.5 lakh, 4 lakh in the next slab, 7.5 lakh is the average income, 15 at the highest slab. Tax amount, you apply that tax rate and this is what you will get. 3 to 5 lakh slab, they will have to pay, if the average income is 4 lakh, it will be 10,000 rupees, the tax. This is income tax I am talking about. I'll come to the other indirect tax or GST sort of a tax in a minute. Now, let us get this clear. Now, income tax system where the rates progressively increase, what will happen is that you show, fourth column shows you the tax amount, 10,000, 70,000, 2,70,000 on those incomes, average incomes of 4 lakh, 7 lakhs and 15 lakhs will give you, it's 2 point bottom, up to threshold there is no tax, so it is actually 0, and then it becomes 2.5% of your income. In the next slab, it becomes 9.33, and the highest slab, it becomes 18%. That we can call a tax burden. Now, as you could see, this is called progressive because burden of income tax is low on the lower incomes and goes up as your incomes go up. That's how it should be. That's why it's called progressive. Now come to something where the tax rate doesn't change. And now look at what happens to, and there's no exemption. Just see what happens to the tax amount. It's 25,000, 40,000, 75,000, and 1,50,000. In the tax burden, it will be the tax rate, 10%, because it's on the income. I hope it's clear. Now this is very regressive. If it's a uniform rate, it's the same, 10%. And that, you see, that should not be the sort of a case. Why should the poor pay the same 10% which the rich pay? That's why it's called regressive. If you have a system like this, it will be regressive. Next, please. Yeah. Now let us come to GST. Now, same incomes. Now, I have only shown I have not shown the income slab. That's not relevant. Incomes of these different average incomes. At the bottom, households with a 2.5 lakh income and their consumption, the consumption basket, assume that the consumption basket is the same for all the groups, at least a minimum sort of a consumption. This is the basket. Now it costs 2 lakhs and GST is 10%. That means everybody ends up paying 20,000 as tax, GST, on this consumption. Now you look at the GST burden. At the bottom, 20,000 on 2.5. 2.5 is the income. That is 8%. 20,000 on 4 lakh, that's 5%. Now look at the GST burden. You see, it's actually it's lower for the richer. It systematically comes down. And suppose there is a person or a household with the rupees 2 lakh as the, no, suppose there is a household below that 2.5 lakh income level. Say the income is 1.5 lakh and the basic, consumption basket costs you 2 lakh. The households which have that 1.5 lakh as the income, how much they will have to pay? Or how they will also have to pay the 20,000, but already their income is only 1.5 lakh. If they require the consumption basket of 2 lakh, they have to borrow that 50,000 plus 20,000 tax on that 2 lakh consumption. That means they have to borrow 70,000 to sustain themselves. So how serious this regressive issue could be? Firstly, you have seen that 8, 5, 2.67, 1.33. The consumption basket, a fixed consumption basket, this is what you will get. Of course, the richer will consume various other things. That's a different thing, but that doesn't really increase this very much because then they are not comparable in the sense in which we are comparing here. I hope this is clear. So that's why theoretically, what one says is that GST is very regressive compared to our income tax system, where the rates increase as the incomes go up. And then you saw what happens to the tax burden. As it goes up, lower incomes, it's low, higher incomes, it becomes higher. Whereas GST, since the rates are uniform, there is no exemptions. Then you see, if the same basket, the consumption basket, you hold the consumption basket the same, what happens is the GST burden higher for the lower income groups. I hope it's clear. Next, please. Now, if GST or value-added tax is regressive, and if people know or the administrators know that the poor are adversely affected, then why is it that countries after countries have gone for this? Of course, one answer to that, the production efficiency, you already explained that. Now, there is also some other dimension, that is the revenue productivity, that is the government revenue. Now, it's a very interesting, I don't know whether you heard of Parthasarathy Shom, the Indian economist, who has come up with an index which is fairly well known in the tax world. Now, the relationship between VAT or GST rate and its revenue implication is given by what's called Shom index. What he said is that for a general GST rate, if the rate is X%, your revenue will be half X of GDP. Half X%. That is, if GST rate is 10%, you will get a tax revenue of 5% of your GDP. Now, this is possible when GST system is, base is very broad. That means almost every goods and services are taxed. Administration is transparent and not too many accompanying lower rates or exemptions. Then you will get this, that if you have a 10% GST rate, 5% of GDP will tax. That improves the efficiency of, how much tax you will have and things of that. For governments, it makes your life simpler. Next, please. Now, that's why some of the early implementers of GST or value-added tax, they had like Chile and New Zealand, the VAT bases were very broad. Chile taxed at 18%, and their revenue at that one point was 9%, upholding Shom index. Chile taxed unprocessed food and fresh vegetables, almost taxed everything. New Zealand is one extreme where birth and funeral services are also taxed. And their revenue, because it was very broad based, were comparable to that of Chile, following the Shom index. Now, if the GST or value added tax base is low, as in UK, that is, if you have too many exemptions and things of that sort, then what happens is the Shom index, it doesn't give you half X%. It actually, in the UK case, it's one third. That is, UK has a GST or value added tax of 17.5%, but the tax revenue is only 6%. Now, so what it means, that's an extreme case. So what it shows us is that the GST revenue that hovers between 1/3 of X% and half of X% in most countries, depending upon what exemptions, how, whether it's a dual rate and, things of that sort. Next, please. So, why countries opt for this. It's very simple to design and administer, because administer, as I said, it's self-enforcing. Then the tax official has very little to do, because input tax credit, if you have a system where it works when everybody collects bills and everything is above board, there is no sale without a bill sort of a thing, and compliance is likely to be higher, and the compliance cost is lower because bookkeeping then becomes very simple. And revenue is productive and predictable. For governments, revenue is productive. If it's 12%, roughly how much will be the revenue. Or if it is 15%, how much is the revenue. And more importantly, in a fiscal emergency, suppose suddenly you want more revenue. What you do is GST of 10%, you make it 11%, you know how much you will get. You don't require an economist or a statistician to do the complicated computations at all. Just apply Shom index. Given that your system, fairly good idea about your system, then you know that it will be 1/3 to half of what if you raise by 1%, you will definitely get 0.3% of GDP as your tax, but it can be higher, between 0.3 and 0.5. So that is the advantage. That's why governments go for it, producers support it, but as far as the consumers are concerned, it's highly regressive. And how is it addressed? It has to be addressed from the expenditure side. Next, please. Now, when I say expenditure side, you see, as I said, if it's a unitary country, only one government, you don't have multiple levels, then it's all very simple. The fellow who collects revenue has to spend to address the regressivity. But in a federal countries, what happens? Now, we have two examples before us. Canada and Australia are comparable to India because both the countries have provinces like our states. And Canada did two things to get provinces on board, to impose or move over to GST system. Canada's federal government or the central government has had to bargain with the provinces, and the provinces agreed to be on board when the federal government agreed on two things. One, the provinces were given the power to decide provincial GST. That means our SGST, in our case, CGST rate is equal to SGST rate. We keep on harping on the great advantage and all that. But Canadian system, you look at it, the SGST or the provincial GST, they decide. It's not decided by the GST Council or the central government. Secondly, the federal government offered compensation to the consumers. As we saw, it's a regressive sort of a thing, tax. So consumers end up paying more, it's irrespective of what is their level of consumption. So for a whole lot of consumers, they are paying tax, they are not getting anything in return. Now, the provinces in the Canada, they bargained with the federal government and made the federal government offer compensation to the consumers, hard cash to the consumers. Australia too offered compensation and agreed to devolve the entire GST collection to the provinces. So in both the countries, the provinces, they gave a tough sort of a time to the federal government. Acceptance of the move over to GST was conditional on these things. Australia, entire GST collected goes to the provinces. Center doesn't get anything. Canada, the provinces have the power to decide what rate they will charge. The central government says, okay, 5% or 6% CGST. I take that. You decide whatever rate you want. That's why it varies enormously across the provinces. Now, where does India stand? Now, India, forget about the consumption, compensation to the consumers. The central government, when they bargained on these things, states didn't demand it, center didn't give it. So consumers were left, to their fate. And SGST rates, we keep on harping on this 50-50. Why? I don't understand that at all. and you see, if there is an emergency for a state, there is simply no way they can raise revenues. Next, please. Now, this is the point. Now, states simply, this is in another way, we can say fiscal autonomy of states is gone. They just cannot decide. Even if there's a huge sort of a, flood and massive destruction, they have to depend on the center's team coming, assessing, because even if the states decide something, where do they have the resources? They just cannot raise the GST rate, GST rate. So, what the GST in India has done is that hasn't given the sort of powers these Canadian provinces have, nor did the central government compensate the losing consumers. So it's said that the revenue balance is in favor of the center. Even the September sort of a great announcement of, what is that, fewer rates. Now you see that also left the states with the fewer resources and compensating the consumers. Because state governments are nearer to the consumers, not the central government. Delhi is too far for all of us, including Gujarat. So you see the burden falls on the states. And that's why you see states, for example, when Karnataka, the last elections, 23 elections, when they went for what's called 5 guarantees, that is 10 kilograms of extra rice, compensation for the women at 2,500 rupees per month and all that, everybody made fun of it. But if you look at their budget of that year, there's a very beautiful, I request all of you to have a look at that budget, that section where these 5 guarantees are explained. In fact, it's very beautifully put, saying that basically we are collecting so much GST from these poor. And what are we giving them back? We should be giving them back something. And also in the process, empower women and things of that sort. So that is the way probably we will have to look at some of the states, what they have done. The burden is fallen on them. They have taken up the burden. They have compensated. So that's the difference between us and Canada or Australia. I think next slide. I think that's the, thank you very much.
Thank you so much, Professor D. Narayana, for this excellent lecture. Most of the economists, what they do, they take the final output, the final data from the government websites, that how much has been collected as revenue on the GST front, and then use that data as variables and but I did not have so much of conceptual clarity before hearing your lecture. I mean, it's so vivid. What is the inside story in it? How it is calculated, and what is input tax credit? How well, why and how GST is more transparent system? How it aligns with value-added concepts? The competitive advantage and disadvantage in terms of international trade when the country is dealing with the other countries in terms of trade and in terms of progressive and regressive taxes and many things. And it's, of course, its features. So vivid and so basic. Basics are very important, what we often ignore. Thank you so much. I now go to the audience. If there are any questions, please raise your hand or ask the question to the speaker, honorable speaker. If there are any questions.
Subrata, I do not expect many questions because if you are so, able to put it so vividly, that means things are fairly clear. So anyway.
Ask a question.
Yeah, please.
In one line, if we say that political economy of the Indian state depends on its federal structure, would that be correct for implying from your presentation? I mean, it's a broad-based statement, but
no, in fact, the GST system, as it has evolved, has eroded that federal thing altogether. It is actually moving much more. See, even if you look at the GST Council, even if half the states join together, demanding, the levying the SGST powers for the states, it will not get passed if the center doesn't want it. So, in fact, I would say, like many critics, without, they have not argued it out clearly, but as it's clear from my sort of a presentation, under RST or retail sales tax or what existed before GST, at least the states had their own revenue. Now they don't have own revenue at all. It's all GST Council. That means if the center doesn't want something, the states are not going to get it.
But you gave the example of Karnataka having 5 different.
Yeah, but now you see, everybody is criticizing them, saying that you are not spending enough on infrastructure because they are, they are doing this because they feel their ideology. In fact, Ramaiah is also, the chief minister is very, very clear on that we have to pay this back because we are collecting such huge taxes from them. So we have to compensate them. But then they are paying a price. In fact, a lot of, staffs, fairly higher up in various, industry and all, they are very critical of how not much money is spent on Bangalore and things of that sort. And then saying that because they use the word freebies, it's actually nonsense. It's not a freebie. I have given the logic of that. But they, that's the common language that is used and say that, you are spending your money on freebies. In fact, I'll go even one step further. If a government writes off a loan to an industrialist, they won't call it freebie. But 2,500 rupees for the women, poor women, that will be called freebie. So, see, Karnataka, even if it wants to raise revenue, it doesn't have any option. In fact, with the latest GST rates, they are estimating that they will lose about 10,000 crores a year. That is so in fact, we are systematically chipping off whatever federal sort of a structure that we had.
Thank you.
Can I ask?
Yeah, please.
So, Dr. Narayana, your lecture was very comprehensive, and I think we learned a lot on the basics, as my colleague Subrata was saying. And I think you have also raised that point in the previous question, also kind of reiterates the point that I am trying to make. Okay, obviously, although technically from the presentation also it appears to be a far superior way of calculating and all that. But obviously, as we all know, it has reduced the state's revenue significantly.
Yeah.
So, has it also made a difference in the state's capacity for capital expenditure? After that, and now with this new kind of burden of Manrega being scrapped and other kind of way, so will that also have an impact because already the state's revenues are low, and then will it have a long-term impact on employment in rural areas, etc.? Because and what is the way? What kind of reforms be done so that the state's collection improves a little bit, and whether the government is thinking on those lines, and how can the states improve their capacity for development and infrastructure creation, etc.
Uh, you see, there are two things that are happening. One is when the state's revenue falls, and some of these expenditures they cannot cut down. In fact, it's not only Karnataka, almost all the southern states now have, I think many other states also, who were critical of it earlier, now they have also gone for that political reasons. This payment to women, monthly sort of a thing. One of the very good things that has happened in my view, because if you, there are a few studies that have come out. Money in the hands of the women, where does it go? It gets spent on health, education, children's schooling, children's stress. So you see, these are highly welfare oriented. Money in the hands of men often goes elsewhere, you know where. So you see, and the states, once they have started implementing, they cannot cut down on it for political reasons or otherwise welfare reasons also. So what happens? They then end up borrowing more. Now the recent sort of evidence suggests that states after states, borrowing has gone up. Now the problem with borrowing is when we borrow, of course, you have the money, but the problem comes, the pain comes later because you have to repay. Not only that, the interest outgo. Look at states like Kerala. 20% of your revenue receipts go up as interest, leaving very little for discretionary sort of a thing. So it is having its sort of adverse impact, very severe adverse impact. States after states, especially southern states, because you see, this is something slightly a digression, slightly outside your. Somebody asked me the other day, looking at Sri Lanka, looking at Bangladesh, somebody asked me, now why is it that we don't face that sort of a problem? And my answer, I said, we have a safety valve which none of the other countries have. What is our safety valve? Suppose we didn't have the southern states, for the boys and girls who come to their working age in Bihar and UP or Odisha or Assam, now they all escape to south. Suppose you didn't have that safety valve. In fact, we would have had a Bangladesh or a worse situation in India. Now, instead of compensating these states, now what has been happening over the years is that you collect even the GST revenue and don't pay anything. In fact, the center didn't think of, even during COVID, didn't think of a compensation. States, for example, Kerala state, even for migrant laborers, they had schemes of, giving food kits and things of that sort. Migrants who were left behind, who couldn't go to their homes, there was no work available. So starvation was prevented. And all this requires money. And in fact, my way of looking at, that's why I emphasize this thing, both Canada and Australia. Not so much Australia, but Canada. If the provinces could have a rate which they decide, they are taxing their own people who have elected them. Why should the center or anybody have any problem with that? And it will not complicate matters because we are the IT superpower. All that, whoever the GST Council contracts with, those chaps have to evolve the system. That should not be difficult for us. So allow the state If they want to give more money to their women and by raising the SGST, why not? Allow it. So then, they would not have a grudge against the center saying that you are not giving us money. They will say, the center could say, no, you can fix your SGST rate. In fact, this was done in a very different way by Kerala for 2 years. After the 2018 floods, Dr. Thomas Isaac, the then finance minister, argued very strongly for a cess. And somehow the GST Council cleared it. And the cess gave them something like 2,500 crores of additional revenue. So we already have models before us. So why don't we go in that direction? Reforming GST in that, of course, reducing the rates, right? You have done that. But then, states should not lose. Give them this autonomy or the power to levy the SGST rate. Then I think quite a lot of these problems will. So I hope I have answered your question.
Yes, sir. Thank you so much.
If there are any more questions, last one or two. No questions. Okay, Dr. Bachaspati Shukla, may I request you to please give a vote of thanks?
Yeah. Thank you, sir. On behalf of Sardar Patel Club Economic and Social Research, I extend my sincere and heartfelt thanks to Professor D. Narayana for delivering an insightful and thought-provoking lecture. Sir, your rich academic experience and deep policy engagement greatly enriched our understanding of the subject and provided valuable perspective for research, teaching, and policy discourse. I would also like to express my sincere gratitude to Dr. Subrata Datta for ably moderating the session and steering discussion with clarity and precision. My special thanks go to the technical staff for their seamless coordination and to all the participants for their active engagement, which made the session truly interactive and meaningful. With this, I finally conclude today's program. Thank you all. Thank you, sir.
Thank you very much. Thank you.
Thank you so much, sir.
Thank you. Thank you once again.
Thank you.
Thank you, sir.
Okay, what is this? So can I leave?
Yes, yes, sir.
Yes.
Thank you.
Okay,
Yes,
thank you.
thank you.